I'm Russ Mould, AJ Bell's Investment Director, and with me is Richard Penny, Manager of the Legal & General UK Alfa Trust and also a Special Situations Fund for Legal & General. Now, the Alfa Trust particularly covers a full range of UK companies, big to small, but his real expertise is probably in small caps, and AJ Bell Youinvest is aware that a lot of you, our customers, would rather do it yourself and pick your own stocks rather than perhaps pay Richard a few quid to do it. So Richard's here today to help talk us through some of the do's and don'ts of small cap investing based on his personal experience. So Richard, before we really get stuck in, what do people mean when they refer to small caps when it comes to stocks? What sort of market cap are we talking about here, or company are we talking about?
Yeah, realistically, it's the bottom 10% by value of the stock market. But in practical terms, that's probably well over 2/3 of the companies out there, maybe 80% of the companies by number. So the very big companies are something like Shell at 7% of the market is probably as big as most of the small companies out there.
Put together, yeah.
Yeah, and it's logical, I would think, that with that amount of companies, it'd be possible to find some really good ones down there.
And looking at small caps in general, are they young companies? Are they profitable? Do they pay dividend? Do they have sales even? I presume there's quite a broad spectrum from startups to still fairly mature, shall we say.
They're classified by the valuation of the companies. So in the extreme, a company with a lot of debt, it might be a big company that's got very little value for the shareholders, and it may be highly risky, but it could go up an awful lot, or it could go bust if it's one of those. In the past, companies such as British Steel have fallen into the small cap category. But generally, they are younger businesses, and those are actually a really good source of entrepreneurial growth. Entrepreneur can often be seen as a negative connotation, which is a great shame that's been the case in the last 10 years. And in the sense that the entrepreneurs take risk. I mean, risk again can be seen as a negative connotation, but sometimes if you take a risk, you get a higher return.
Right, and I guess that's the ethos of small cap investing, is it? There is potentially high return there, but in exchange for potentially taking greater risk. And I guess risk in investment terms is best defined as losing your money, I suppose.
It can be, I think it can, yeah. I mean, that is a reality of small cap investing. At that point of investment, everybody sets out with the best intentions, they do their work. But in reality, there are circumstances.
And so that's the kind of the trade-off that anybody looking at an individual small cap or even collection of small caps probably needs to be aware of.
With the top 100 companies, some of them may in extreme half in a downturn, and the upside, they can double. But with some of the smaller companies, over a longer period of time, they can go up multiples, 5, 10 times. But you can lose the majority of your money if you get it wrong. So people do like to do these things themselves, but they just need to understand the risks and the practicalities of it. It is a higher risk-reward proposition.
I mean, if you look at AIM, the junior platform, which I assume is where a lot of the small caps tend to live, its combined market cap is about 70 billion sterling. The FTSE 100 is 1.8 trillion. So AIM is about 2-3% of the FTSE 100. So without giving anything that could be misconstrued as financial advice, using that, is it sensible to use that 3% as a benchmark for small cap exposure in a balanced portfolio, depending on an individual's risk tolerance and investment goals and time horizon? Or is that probably too simplistic?
I think that may be a starting point, but you have to look at the other financial products that individuals are exposed to. So, a life insurance portfolio or a pension fund
look at it in the round.
Run by somebody else would probably have a bias towards the larger companies anyway. So they're going to put 5 or 6% of the portfolios into the very big index.
Shells, BPs, HSBCs, those people.
Yeah, so if you're diversifying away from that, perhaps you could put a little bit more there, bearing in mind the risk-reward tolerance that individuals may have. And even within smaller companies, there are different levels of risk. Some companies are very well established, will be paying a dividend, but then may not offer huge upside. Some companies are not a lot more than a business idea and will need funding time and time again. And from the way I discussed those, you might you may gain the impression that I don't think that is necessarily highly prospective. But there's sometimes a happy medium of companies that are growing, that turnover's going up. Maybe they've got new products out, run by entrepreneurs, that are available at attractive prices where you can make really good returns.
Perfect, Richard. Thank you very much for your help, and thank you for watching, and we look forward to seeing you next time.
Thank you.